Speculation enters most markets, but which ones survive? Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, welcome back, Drew, on a day where we've got some clarity around the next US president, and markets are a bit mixed after increased certainty of a winner, but maybe a little bit of uncertainty, I suppose, around exactly what that means. How are you going today, Drew?
Good, Chris. Thanks for having me on.
Interesting. It was an interesting night, interesting morning. Now we're seeing sort of gold down a bit, Bitcoin breaking to new all-time highs. It's all over the shop, really. But you didn't focus specifically on that, but I think we'll be able to tie it back in the article today. You really covered a lot of ground in the article today. It was quite a good one. I thought we'd start off by talking about really global liquidity and speculation, because there seems to be a bit of that at play at the moment after the election in particular. But you mentioned that we've got this flood of global liquidity. It's fueling those speculative tendencies across markets. Do you maybe want to talk us through a little bit about what you were getting at there? Maybe the central bank rate cuts, they're accelerating that a little bit. Just talk to us a little bit about what's going on there and what we can maybe expect to see coming out of that.
Yeah, absolutely. So, from a global liquidity point of view, we're about a third of the way through a macro liquidity cycle. So, we can expect liquidity to continue accelerating upwards from here. A big part of that, like you touched upon, is the central banks cutting interest rates. So, we've embarked upon a rate cutting cycle now, well and truly, with the first rate cut by the Federal Reserve already being done, and we're expecting a second one this week as well. So what happens with that is you start to see looser monetary policy. For a variety of reasons, rate cuts will cause liquidity in the system to actually increase globally.
Hmm.
One of the reasons is that when you're in a interest rate cutting cycle, what you're usually seeing in parallel is also a bond yield cycle where the bond yields are dropping. What that means is with bond yields reducing, the collateral value of government bonds goes up. So if you've got banks that have purchased a whole bunch of US government bonds at a certain value, these bonds are yielding a certain return in terms of the bond yield. Now the bond yields have dropped. So the bond yields that they were holding that are yielding higher amounts are worth more on the secondary market. So that bond collateral has increased in value. So the bank's balance sheets are now looking a lot healthier, which means they can actually lend more money and create more debt. So we've got private debt that increases when the bond yields go down in value. The other thing is when the interest rates are dropping, the Fed funds rates has reduced and will continue to reduce. So what that means is borrowers are actually able to borrow more as well. So you've got individuals, organizations, and governments that are actually able to borrow more money, further increasing private liquidity injections into the system. So it's not just central bank liquidity that goes up through various mechanisms that they've got, but then you've got private liquidity injections that happen with the rate cutting cycle as well. So all of this just points to that macro global liquidity cycle that should continue on, and that will have a pretty significant effects on all markets. But as you get further along the liquidity cycle, you see it affecting risk markets more and more, where the further along the liquidity cycle we are, the further along the risk curve investors are as well. So we should see an interesting correlation there coming up.
That's really interesting as a analysis to talk about what we have seen recently. I mean, very recently, really, with the election, because we had that. You're always going to have a little bit of volatility around an election, but what I find quite interesting, you touched on the article, this idea of a wall of worry. Now, it seems like we've had negative news right up until the election, really, and now we've probably got uncertainty, but I think we'll end up back there again with that negative recession fears, all of that concern. But as you just pointed out, the liquidity situation theoretically is improving and looking relatively good. So maybe if you could just describe to us what it's meant by that term wall of worry. But I think you probably hit the nail on the head that that's what's been going on recently. People expect it to go down, but we've just hit new high after new high.
Yeah, the wall of worry is quite a confusing phase for most market participants. It's essentially so the market will top at the peak of the previous bull run, and then you've got the bottom of the bear market. That range that's created, the market moving up through that range is usually when the market is climbing the wall of worry. So what you'll see is sentiment is down in the dumps at the bottom of the bear market. And it takes a long time for the momentum behind that negative sentiment to turn to a truly bullish sentiment across the board, across the
Mm.
entire, across most market participants. So as it's climbing up from there, you'll see the price go up a little bit. It'll hit a first resistance point on the chart, and sentiment will become increasingly negative, and everyone will think that, okay, that was just a bear market rally. We're going to collapse. Price will correct a little bit, but then it'll continue up to the next bit. Now, when it hits that point, there's usually some global event or some type of fear that's legitimate that people will latch onto as the reason why this market can't continue up anymore. Could be banks collapsing, could be something to do with war or some sort of political event. But generally, people will say, oh, yeah, the markets can't possibly go up in the face of this situation. Markets will correct and then continue up on the next leg higher. This is a function of liquidity, just a function of a cycle and various elements at play that are just going to continue the cycle moving up. Now, each time it hits a a resistance point as it's moving up, the pullbacks tend to get shorter and shorter. So you can see the market actually gaining strength. And these fear phases last less and less time as well. So you're
Mm.
seeing shorter pullbacks for shorter periods of time, or well, shallower pullbacks for shorter periods of time. And as you get higher and higher, you work through one worry after another. Now, the point where you sort of feel like the wall of worry is completely finished usually is at the all-time high of the previous cycle, right? And at that point, a majority of the gains have already been done. Most market participants have sat out that entire run up for what seems like a bunch of valid reasons. Once you're at the all-time highs, it's blue skies ahead. Generally, at that point, what was a steady rise with shallow pullbacks along the way will change to a more exponential rise. There's no resistance levels anymore, and you start to see parabolic price increases. At that point, the train has left the station. Everyone's trying to board it all at once. And the markets start to get pretty overheated. So that's really the time when you want to be sort of gradually taking profits and reevaluating how overheated the market is after the wall of worry is already behind us. So bringing it back to the election, arguably one of the last few points in the wall of worry is the US election. And the markets that I personally use to assess risk appetite, and we can pull up a chart of this as well, is usually smaller market cap indexes. Like in the stock market, you could look at the Russell 2000, where we've been climbing the wall of worry, and we're just breaking up above the what we call the complacency bounce of the previous cycle. And we've been breaking up above that for a while now. And what I feel like is happening is the US election might have been one of the last few points in the wall of worry. Once we break above the complacency bounce, it's the all-time highs that are next. And after that, the rest will be history.
And is that related? Because you also use the term the winner's curse, that phase where you've got liquidity and you've got that leverage increasing before, as we sort of get to the top before it pulls back, we have that big collapse. Is that sort of correlated here as well, where you're approaching that end of the wall of worry and you then have the winner's curse? Like it makes sense, right? Terminology wise.
Yeah. So the winner's curse is a phase where all markets are going up together. Investors can't really do any wrong, and
Yep.
everybody feels like a winner. And that leads to increasing complacency, increasing greed, over leveraging, and it ends up becoming a curse because they feel like they can do no wrong. And when it's time to actually pay attention to certain issues in pricing and in markets and maybe take some off the table or move into risk off markets, they're just so complacent at that point and they're so over leveraged that in the bear market to follow, they're not positioned for the collapse.
And is that because, as you just described, when you're climbing that wall of worry, they were wrong so many times in a row that ultimately they go, oh well, hang on, I was worried about a bear market this whole time. I was wrong. I was wrong. I was wrong. I've got to stop. I've got to have a positive mindset now and take a little bit more risk because look at all the money I lost during that wall of worry phase, and then they end up making the same mistake in reverse. That's effectively what's happening there, isn't it?
That's a huge part of it. I mean, investor psychology is such an interesting thing because it's you take a step behind before that as well, and you've got the bear market where on the way down they were thinking, oh yeah, it's going to go up, but then it reaches the bottom and they go like, oh look, it's gone down for so long, it can't possibly go up. Then it goes up while they think that it can't possibly go up, and they were wrong then, and then they're right for a little bit. When everyone is right at the same time, that's the winner's curse phase. So
Yep.
there are generally at market tops and market bottoms, it does pay to be a contrarian. But there is a phase in the middle where everyone is right at the same time. And that's, it's okay to follow the herd at that time. And that's essentially quite typical of the winner's curse phase. That's generally what you'll see.
So we could be coming into that very soon, arguably, if we're not on the edge of that right now. But turning the conversation to gold and silver specifically, I mean, you noted in the article today about that long-term resilience during the speculative and collapse phases. So it kind of serves a dual purpose there, working in both of those somewhat tricky psychological phases. Do you think there are some specific factors that give the precious metals an edge in that environment? What's your sort of take on where gold and silver fit, specifically around where we are now, or potentially about to be in that sort of topping process?
Yeah, definitely. Gold and silver are in a very unique position because they benefit from the liquidity increasing in the wall of worry phase. They benefit from the liquidity increasing in the winner's curse phase as well. And from a timing perspective, and pretty much from every angle you look at, whether it's sentiment, or macro cycle timing, the winner's curse phase is expected to be next, or maybe we're just getting into it now already. What follows the winner's curse phase is a broad-based systemic collapse, and most markets will not do well in this environment. So when you see risk assets doing really well during a speculative frenzy because there's so much money sloshing around the system, gold and silver will do well at that time as well. And one of the main reasons everything does well at this time, apart from complacency and speculation, is that there's just more currency in the system. So when assets are priced in something where the supply of that thing is increasing and its value is decreasing, I mean, the assets themselves gain value in that currency. So you'll see gold and silver gain value because the US dollar is losing value in the speculative phase, in the phase where everything's going up. But when everything's collapsing, anything that's attached to a specific financial institution or company or hedge fund or government might struggle.
Hmm.
Gold and silver are completely decentralized. So without any counterparty risk, they're something that will give you that shelter from the storm. So, you'll see everything go up together. And when there's an incredible amount of over leveraging in a speculative frenzy, you'll actually see risk assets outperforming everything for a very short period of time. And this time people, might make fun of like, oh, why are you in a risk off asset? But then what follows after that is when the collapse happens, risk on assets really struggle to recover after that for years and years. And gold and silver actually start going into their own parabolic phase and their own speculative sort of frenzy, especially in silver. So that's something that you can hold to benefit from increased liquidity, get shelter from the storm, and then get massive capital growth all through the winner's curse phase and the collapse that follows. So it's a very simple investment strategy for most people.
And I mean, to wrap this up, I need to. This is probably more of a personal question from my perspective than anything. The silver outperformance dynamics here. Now, it was a few weeks ago now that you first sort of started coming on and really making me think. And I did spend quite a bit of time thinking about the gold silver ratio and the fact that, I mean, today we're back up above 85. And I actually did sell some gold just this morning to purchase some more silver. I've almost been doing a dollar cost average of that every few days at the moment. It's it's a trade that I've always known of. Obviously, I'm in the industry. We talk about it, we think about it, but I hadn't taken that action until you really challenged me on that. And now I can't get enough of it. I just keep seeing that higher gold silver ratio. I'm going, I need more silver. I need more silver. You talk about it in the article today. Really, the potential of silver to outperform even gold in that recovery phase, post crisis potentially, but also do you set up a little bit for that here? I can't get enough of discussing this. So just talk to me more about the gold silver ratio here and silver's role specifically, where we are at the moment.
Yeah, definitely. Silver's so exciting right now. Now, if we look at leading into the crisis and during the crisis, gold will outperform silver initially, and that's why the gold to silver ratio will take some time at these higher levels. These cycles take a long time to play out. I mean, silver generally has about 100-year long cycle that it plays out on a really macro level, and the gold to silver ratio follows this cycle as well. So we can pull up a chart as to what the gold to silver ratio has done back at the fourth 20-year cycle of the previous 80-year cycle, which is where we are right now. We're in the fourth 20-year cycle. So looking back at what silver did just after World War II, gold to silver ratio very similar to now, spent about multiple decades at these high levels of 80 to 90, and then it spent multiple decades dropping off all the way down to below 20. So there is that expectation that something like that will repeat, and silver against the US dollar will go on a multi-decade bull run. The reason that this happens is while people are looking for shelter from the storm, they'll go into precious metals, gold and silver both, predominantly gold, because it is the premier AAA asset for safety. Now, post crisis, when most other markets are struggling and gold and silver have been continuously and steadily rising for years and years, most retail investors will start paying attention to the precious metals market, and speculation starts to now enter this market. When speculation enters this market, silver has a much smaller market cap, much lower liquidity. So the same amount of money entering the silver market as compared to the gold market causes a much higher increase in price. So the percentage return on investment and the growth in silver starts outperforming gold in a big way after the crisis. What this does is this is when the gold to silver ratio essentially starts to fall off, and you see that massive drop off where silver is catching up to gold. So essentially, with silver, you get the safety hedge, but then you can also get massive amounts of capital growth. And once you start seeing that ratio fall off, it's not the worst idea to start converting silver back to gold, or just buying gold at that stage.
And I have to ask one more question, just because, as I said, I cannot get enough of this discussion. Um, what are the warning signs then if we have over speculation in silver? Because I'm starting to think that it doesn't really matter if that GSR is remaining high. If there's a lot of speculation in silver and the ratio is still high, you go, well, it's still high, right? Like it's still got that move relative to gold. You're still going to end up with more gold in your pocket at the end of that. How do you think about warning signs for over speculation in silver?
Yeah, exactly right. It's all about the gold to silver ratio. So I don't really think it makes sense to pay any attention to what silver is doing against the dollar or against any specific currency. These currencies come and go. Every currency will eventually return to its intrinsic value, which is zero. And gold and silver have been around for thousands of years. So the idea of counting your wealth in a hard asset like gold makes a lot more sense to me than counting it in a asset that's constantly losing value like the dollar. Because having $500,000 of wealth 50 years ago was a very different thing to having $500,000 of wealth today versus having 5 kilos of gold 50 years ago was probably the same as having 5 kilos of gold today. So it's a lot more stable in terms of looking at your wealth over a multi-generational time frame. So when you're looking at the GSR and you're talking about silver being overvalued or undervalued, objectively speaking, when priced in gold, that's what you're looking at essentially for seeing when speculation has entered the silver space. So if it's undervalued in gold, it's undervalued. When it is getting to that point where it's sub 20, I think it's safe to say at that point, yeah, silver's getting a little bit speculative. Let's solidify some of this into gold or in the currency of the day, whatever that may be, turn it into dollars if you want. But the way to judge that really is the gold to silver ratio more than anything else.
Look, as I said, can't get enough of this discussion. We'll be coming back to it again, no doubt, because it's really playing on my mind a lot at the moment, and I am taking action on your advice there. So, thank you as always for your deep dive on all of that today. Really great article and lots of really useful information in this discussion. So, thank you for that, Drew.
Absolutely, Chris. Great to chat as always.
Thanks everyone for watching. We'll chat again soon.